right, good morning, good morning. Good morning, happy Thursday. Welcome to Forex.Today, the YouTube channel of 18,000 foreign exchange traders stationed around the world. Everyone is synchronizing their watches. They're saying it's 8 in the a.m. New York time, about 90 minutes before the stock market opens. So without further ado, let's get on with it. Let's go. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ohio! Hey, my name is Wayne McDonald. I'm a currency trader just like you. Welcome to Forex.Today. We're going to cover technical analysis, fundamental analysis, trader psychology, with the overriding goal of teaching you how to put together trade plans that predict the future and help you execute your trades today, depending on what your future bias is. Please treat your fellow currency traders with dignity and respect in the chat. You are in my office, so be professional. I don't mind a few jokes here and there, but if you're a spammer, we're not interested. Okay? That kind of stuff. What else? Ask questions, get involved, take notes, and have positive energy. All of that's really good. Thank you for being part of the community. Thank you for being a subscriber. Thank you for being part of Forex.Today. Thank you for being part of FX Bootcamp. Or thank you for being a client to Trader's Way. If you're not a client, guess what? They're part of our community too. And they want traders that have a background that understands the markets. They want traders that have the skills necessary to enter trades and be profitable, so that you can trade day after 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 week 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 after month 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 after year after year after year after year without blowing up your trading account. They actually want clients that can be successful so that they do a lot of business with you. You make trades, they execute trades. There's a symbiotic relationship. So that's why they're part of our community. That's why you're part of our community. So maybe give them an opportunity to earn your loyalty and respect like they've earned mine. You start that relationship building by visiting tradersway.com and open up a demo account. Grand rising to you, Sophie. Okay. Here we go. What do we have here? Well, the interesting thing is there's some euro strength. Of course, we got that going on. Guess we should pull up the calendar. Forex.Today. News calendar. La 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 la. Okay, so we got this going on. So that's good because you can see euro is decoupling from just anti-dollar. It's actually strong. Well, what do you know about that? Pretty interesting, huh? So now we have to say, okay, so we got that. So that's interesting. The yen strength, if you remember, starting back in late March and the very first day of April, we've been looking for a rotation from generally yen weakness to generally dollar weakness. Doesn't necessarily mean strong yen, but at least neutral yen compared to the beginning of the year. And man, just like right on time, just slammed into, right? Look at that, right in the middle of March. Look at this, almost March 15th. And then all of a sudden, just sideways, sideways, sideways. After down, 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 down. So maybe you've learned a few things about seasonality. Maybe. Could be. Could be a rabbit. Could be. Pretty interesting, though, huh? See how easy Forex is? All you have to do is accurately, know absolutely everything in the world and accurately predict the future every single day. So right? Look at that. Just amazing. So now I would sort of imagine we fart around with a little bit of yen strength and then a little bit of yen weakness, then a little bit of yen strength and a little bit of yen weakness, all for many months, actually. Not just for, many several moons, multiple moons, probably until at least October, third week of August. So, so you got to change your strategy. And that's why we talked in the middle of March about preparing and then executing a rotation strategy from one basket to a new basket. Pretty cool though, right? Come on. Bump. Knuckle bump for that, don't you think? You now are rotating out of portfolio baskets. Cool, right? Well, I think it's cool. So, dollar neutral right now. Okay. Pig really let me down. I missed, if you remember, last week, I had a bullish trade plan on it, and then I put a trade on it, and then I got knocked out at break even on some weird little price action. I accidentally moved the stop. Actually, part of my coaching, I accidentally grabbed it and moved it. But whatever, I prematurely moved the stop, and then, of course, I got knocked out at break even. Then it jumped about 220 pips without me. And then yesterday there was a pullback, and I bought it at, $1.39 or whatever psych level. And I went to bed last night up 40 pips, so I moved my stop to -3. Sure as poop through a goose, I wake up this morning, and I'm like, where's my pound trade? Take you, pound! So anyways, I was loving it. I was living the dream, and but whatever. It's one of those things where you take as many free looks at the basket or at the net as possible, and you take your shot. Okay, Kiwi down, Aussie sort of down, CAD down. So a lot of commodity. You know what this feels like to me is a big hesitation. Right? Just a big hesitation. Really, if you look at it, nothing really going on that's very exciting. So maybe you temper your enthusiasm. Maybe you don't trade a lot today, or if you're in your trades and you've given back some, maybe you don't panic or whatever. But the only thing moving right now is euro, and there's a central bank, decision going on. So if it wasn't for that, everything would be neutral, right? So, right. So anyways, la-di-da-di. So let's do some commodities. Okay. And nothing's happening there. This was the big thing we've been talking about, though. If you recall, we started this conversation here. And we said what this predicts is this. Can anybody agree with that? It's either this or this. Yeah, Johnny, any rotation from, let's say, basket A to basket B, which is a portfolio. This is how professionals trade, right? It's sort of like thinking about vintners in like Napa Valley. And they all say, I don't know, September they're going to harvest their grapes. And everybody generally agrees with that. But every single vineyard picks on a different day, or just so happen to pick on the same day, but not everybody, right? But they make individual decisions this day or that day. And then inside of that, they might not say pick all the grapes, like pick from that hill, because they have more sun exposure, but the valleys will leave, another couple of weeks, and then we'll pick those once we're done with the first ones. And they're all making different decisions. So when do we move from point A to point B, right? Like you're saying, Johnny's like April seems to be slow. Well, it's slow because we're right. They're all slowly making these decisions, but I'd say by the end of May, whatever you had decided and planned for at the beginning of April has probably come to fruition. And now you'll be like, let's say June 1st, you'll look back at where we've been and you'll say, oh, wow, it seems slow in the moment, but now look where we are now. And this is really a problem with day traders. Well, not a problem, but one risk that day traders have is they get caught in the choppy waters and they can lose money, or nothing's really happening and they get frustrated. And then all of a sudden 3 months goes back and you'll see that there is a rise out of a consolidation, and a day trader could be lost in there, lose sighting of the trend, lose sight of, I don't know, whatever. And even though they're there every single minute, miss it. It's sort of like you're walking through a forest on a path, and then at night you're walking and you kind of lose the path, and night makes you wander and wander and wander, and by the time the sun comes up, you're completely lost, and you don't know where the path is, and you're certainly not getting where you thought, you're not getting to your destination. And this night part is the slow rotation as everyone makes the same decisions, but on different, right, in different periods. So it's not like, boom, we're all there, right? So if all you look at is a 15-minute chart, you kind of lose the path. Okay? And what I was telling you, and remind yourself, I was very clear about this probably 3 weeks ago, that the market's going to move more like this now. Okay? And what I mean is the path that we're talking about is you're following this path. And what you don't want to do as a smaller term trader is like, what if this was the entire month of April? And now by the time you get to end of April, you've lost sight and you don't really know what you're doing. Right? And you're like, well, it could do this, it could do that, it could do the other thing. And you've lost the path. And I've seen it a bajillion times. And like, let's say over the course of summer, right? So now we're talking like half of June, all of July, half of August, right? So the 3 months there, traders forget this, and they're lost in this kind of action, and they forget that there was, like this. So I don't know. So how about this? What if we were talking about the stock market, and people were talking about growth? Look at that. Growth. Sorry, live in Georgia. Growth, okay? Value. But you could also throw in there like cyclical, and defensive maybe. Okay? So let's talk about this. Like, what if you thought from today to July, you're generally going to buy some growth. Okay? But then by July, that will be over. Okay? And then you want to move to sort of more cyclical because you think the general stock market's going to do this. You don't want to sell, but what it means is you buy Apple here, So I don't know what Apple is anymore. I don't know the stock symbol. Apple, you buy now till July. Maybe you take profit, and then you buy Coca-Cola. You buy it. You're not really selling, but you're moving out of like this big investment idea to this big investment idea because the market conditions have changed. And if Apple comes down 10%, Coke might do just fine because it's going to have probably, I would guess, a much lower beta. And it's sort of cyclical, and it's sort of defensive as well because I think they have a pretty high dividend. So you'll say, well, get me out of the high-flying stuff, take the profit, and then get me into something slow over, right, for the rest of July, for the rest of August, for the rest of September, and then in October, you go back to maybe a growth stock. So now you have to then say, well, so by September, so now you got to have a different color. By September, you might rotate back over to growth. Or during the summer, you look for some intrinsic value in some stock prices that got pulled down. But do you see how, I mean, like professional investors in the stock market, they just don't like flip stocks all day, every day, or at least they shouldn't, right? A proper portfolio would take advantage of these things. Okay? And this is what we would call seasonality. And seasonality lies like is 1 year. The pattern within 1 year, correct? But what do you call this? Year 2 and year 3. If the orange area is seasonality, I guess that I should probably do it in orange. I don't even remember where orange was. Okay, so if the orange area is seasonality, what do we call this period? Fundamentals. Thank you. See, fundamentals last years. Okay. Then there's seasonality. So going back to Johnny's question, he's like, well, you know, it's generally been fine, but still feels slow compared to the last period. Well, all these decisions are being made, just like I gave you an example in the stock market. It's not like every hedge fund and institutional investor says on, you know, let's say June 15th, rotate a portion of the stock portfolio from growth into cyclical, from growth stocks into cyclical. They don't say, okay, everyone should maybe sell Apple and then buy Coca-Cola on the same day. But it's funny how they're all thinking it, right? You see that? Like everyone's thinking it because they're professionals. They're smart. They think and they understand these things. So as we approach let's say June 15th to July 1st, they're all like the vintner's standing in the field. Should we pick today? Should we pick today? Should we pick today? But see, the vintner is thinking about the levels of sugar concentrated inside of the grape and what has the weather been like and what's the sun exposure of this particular part of the field, right? A stock investor thinking about rotating out of Apple stock and then maybe going into something like Coca-Cola because they think that's probably going to be the peak of the year, at least for several months. And now, you know, they need to rotate some cash into a different type of investment. What do they look for? The sun exposure? No, they're sitting there going like, Should we get out today? 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 And what do you think happens on a day where Apple stock starts to drop? All of a sudden, 47 hedge funds all in the same day say, dump $100 million worth of Apple stock and rotate into some sort of cyclical investment for till the end of summer. And it tends to happen on one big day because they're all looking at each other. They're staring at each other. Okay? Now, we don't necessarily have that, but you have to think about the first people making the decision, and then the next people see that decision, and then they make their decision, and then those trades end up hitting other people's stop losses, or in this case, profit orders, and they execute their out, and all of a sudden you get this big collapse where Apple could be down 5% a day, and then the people on TV come out and they're like, oh, it's because of weekly jobless claims, and that points to blah, 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 which is, of course, stupid. Okay? So going back to Johnny's thing, how we make our decision is not quick. That's why you have to say, well, how about this? Will oil be higher at the end of the year? That's the first thing decision you have to make. And then what does seasonality look like? Okay. High demand for crude, and then lower demand for crude. Could this possibly be a truth curve? What do you think of this black curve? Okay. Who buys crude oil? Refineries. And by the way, Peter, Canada sells crude oil. They don't buy it. Well, you know what I mean. They're net exporters. So if peak oil is June 1st, are refineries buying crude oil? Okay. No, they're dwindling down because they're converting crude oil into gas, fuel, like jet fuel, plastic, tar, etc. They're selling product over here. Okay. That's why, you don't buy WTI, you buy gasoline or oil for your car. You go on trips in an airplane and the planes need fuel, right? Fertilizer. Okay. There's plastic in everything that you buy. There's fertilizer in the food you eat. And you're like, well, Wayne, doesn't fertilizer come from cow poop? No, it does not. And it hasn't for 100 years. It comes from natural gas, which is a derivative or byproduct of crude. So when you pull crude out of the ground, there's also gas and other things in the ground with it. So you capture that gas, then you crack the gas, and you pull out the nitrogen, and you pull out the potassium, and you pull out whatever, and you create things like fertilizer. Okay? And then, of course, tar is the sticky stuff at the bottom. Okay? So you crack your inventory. So, okay, you have a cooling tower here. Okay, and you heat it up, and it expands into layers. Okay, so you start with this. Oh, let's do fatter than that. You have a layer from here, and then you have a layer here, and then you have a layer here, and then you have a layer here. Okay, so on and so forth. And it's getting hotter and hotter and hotter as it rises. And it's also getting lighter and lighter. Okay? So up at the very top where it's super light, let me clean this up. Sorry, habit. Stupid Harvard made me do this. Oh. Nope. Everything's got to be perfect. Okay, there's my cooling tower. Okay? And so a refinery buys crude. Okay? A refinery buys crude, puts it in this tower, heats it up under lots of heat and lots of pressure, and the lightest stuff moves to the top, the heaviest stuff stays at the bottom, and you get things like tar, and you get jet fuel. Okay? And maybe down in here you get plastic, polymers of some sort. Okay? And they just suck it off the top. So they suck this off, then they suck this off, and they suck this off, and this, and this, and this, and this. And then they dredge the bottom of the thing, and they now have products. Okay? They suck it out, and now they have products, and they sell. So they anticipate in the second half an increase in demand for these products. So they buy up WTI before the demand because they have to buy the WTI, make these products, and then sell them. That's what they do. They refine it from raw crude into a product. And then they sell the jet fuel, and then they sell the plastic, and they sell the tar, and they sell the lubricant and all that kind of stuff, right? Because this is crude. It's not oil. So somewhere in here is probably oil. Okay? And there's different types of oil, right? So they might create 10W30, 5W30, right? 5W15, etc., etc. And which is a difference in viscosity. Okay, you see? So I'm trying to do this to emphasize that we're getting closer and closer to a point where maybe the demand by refineries for WTI is approaching closer to a top. So imagine now we have sort of May, June, July, August. Have you planned for such a thing? Because a lot of times people just can't imagine. And they're like, well, the stock market's going up, but oil's going down. Well, oil went up back when refineries were buying it. So anyway, it's just a thought process. Did you guys see, oh my God, what's the name of that pipeline company? Reported yesterday or today. The distribution company. It was funny because I almost bought it. Oh, gee whiz. 2 months ago. I almost bought it 2 months ago because of that dividend. I can't remember. Ridley, something like that. I almost bought it. And I told my wife, I'm like, we should probably buy it. The stock's not, I don't think the price is really going to go up, but it pays like an 8% dividend or something. And sure enough, demand and profits were like through the roof. And the stock went up 2% today. Does anyone know the company I'm talking about? Riddle, Madison, something like that. Right? Oil distribution, Madison, Riddle, I don't know. Reed? Is it Reed? Not Riddles. That's funny. Madison Reed? No, that looks like it's something else. Madison Reed, professional hair color. No. Yeah, Barry Riddles. No, I'm talking about a company that does oil distribution, pipelines. No one knows this one? Pipelines. Funny, Barry Riddles. I'm Barry Riddles. Reed Manufacturing, about pipeline and gas journal. No. Kinder. Thank you, Peter. Kinder Morgan. Gee whiz. All right. Kinder Morgan. Let me pull up Kinder Morgan. Sorry. And you're like, what a tard. Kinder Morgan. Kinder Morgan. All right. So I almost bought this a couple months ago, maybe even less than that. So let's look at their asset map. All right. So if you buy this, obviously you're getting exposure to America. Okay. Apparently Texas has a lot going on here. Apparently Texas has a lot going on here. Check this out. North Dakota. Okay. Montana. Right? Coolio. All right. So what is this? Wyoming, Kansas, New Mexico. No, Kansas is farther over, right? Colorado, maybe. North Dakota, South Dakota, Kansas, Missouri, Arkansas, Texas. Hey, not bad for a Canadian, eh? All right. So check it out. You can invest in this company and you get all these pipelines. Look at Pennzoil, Pennsylvania. This is where the oil industry in America started, actually, way up in here. And then it moved to Oklahoma. Here's Oklahoma. That must be Arkansas then. Oklahoma. And then Texas, right? Cool. So you can see these pipelines moving around. Pretty neat. So these guys own the pipelines. So this came out, yesterday. And Kinder Morgan Board of Directors today approved a cash dividend of 27 cents per share. Okay, so $1 a share per year. And okay, and so it's gone up a bit. You can see it doesn't move a lot. So I was thinking probably in here I was going to buy it at 14, right? But let's say back then, okay, 7%. Okay, and I remember telling my wife, I'm like, well, every 10 years the value of your investment doubles, right? If it compounds. Now, that's the thing, is I told her it doesn't compound, but I guess you can take that dividend and then buy more stock. So in that case, maybe it does. Okay. Hey, someone is spamming us. They just started and they want to know if you're going to follow them on their YouTube channel. Not interested, but thank you. Good luck with your career. Maybe after 20 years of experience, you can come back and start your YouTube channel. Cool. Cool. Oh, wow. We're getting spammed like crazy, huh? Just, okay. Okay. Wow. Spamming, double spam like that. Somebody kick Kelly Jones. Just kick her, ban her. Oh, Jim, you're too nice. All right. All right. So anyways, interesting, right? So what we're looking at is, let's put this together. Income is up. Apart from the storm and throughout the quarter, our assets continue to provide strong cash flow and remain guided. Blah, 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 blah. The bulk of our improvement in net income and discounted cash flows is due to strong performance on our natural gas pipeline segment in the face of challenging circumstances presented by the February winter storm. The performance was a result of actions we took, of course. Of course, it was there. It's good because of them. So our outlook, okay, they're increasing dividends, blah, 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 blah. So look, if you just read into this, I mean, you can read this, right? They're going over their business, their pipelines, their terminals, demand for CO, all this stuff, right? Why do I bring this up? This is the kind of stuff that you could be using in your analysis. Okay? So many times people say, well, Wayne, how do you come out with these outlooks? What do you look at? Dude, I look at everything. And right here is I'm looking at, upstream, downstream flow of crude oil, eventually arriving at a refinery, who then makes it into a product and that gets sold. And so I'm looking at the supply side and demand side of the equation for crude oil for a couple of things. Is there demand for crude oil? Is it increasing over last year? Does any of this get exported? How does this impact import exports? Are they up or down? Right? How does this fit in the United States economy? How does this fit in the global economy? That's why I think about imports and exports. How does the winter storm in February change things? And I'm using this as knowledge of if, for example, this does sort of trend sideways to down, has the macro changed? Or is this seasonality? Okay. Okay. Does that make sense? Right? And you're like, wait, okay, that makes sense. Now, if you remember our conversation going back probably Monday, where I was explaining how did I get to my process over, 5 to 10 years of testing and experimentation, right? There's the macro is like the market, and seasonality is like price. So fundamentally, I'm separating the two. Okay. So Mark says, hey, the World Bank says blah, 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 higher, which is good because I've asked everyone to do that. Okay. Go to the World Bank. That's a great website. Look at OPEC, look at EIA. Does anyone look at the American Energy, EIA and IEA, American, EIA. I always mix these up. American Energy, EIA, and how come I can never do this? EIA. So there's EIA and IEA, right? What would that sound? EIA and EIEA. Maybe if I type that in, it'll give us the difference. It's such a IEA, International. No, that's not the one I want, though. That's not the one I want. That's the anti-OPEC. Energy, EIA, IEA, American, the one, API, sorry. American petroleum, Institute. Dude, does anybody know what the hell I'm looking for? API. American Petro. Is it API? Yeah, API.org. It took me that long. Here's another one. Yep. Okay. So what I'm getting at is this. And this goes to Mark's point. If the World Bank says oil prices, okay, up for 5 years, let's say. That's similar to you having a bias. Does the World Bank know? Does the World Bank know? No, it's their bias. Okay? And maybe they looked at the API numbers, the EIA numbers, the IEA numbers, the OPEC numbers, the Royal Dutch Shell numbers, the Exxon numbers, okay, the BP numbers. They put it all together, and the World Bank says, we've analyzed all this data, and we think oil prices are going to go up over the next 5 years for reason A, B, C, D, and E. Cool. Does that mean prices will rise every day? Yeah, Mark says, yeah, well beyond. Right, okay, good. Does that mean prices will rise every day? This is a big breakthrough that I had almost 20 years ago. It's a big deal if you start to think about it. So what does it mean? If prices don't rise every day, and I buy into, let's say I let the World Bank make my decision, that's fine because they have PhDs and they have quants and they've looked at the data. They've done analysis, they've done spreadsheets, they've done models, they've had committee meetings. And then they wrote the report and they gave the report to the entire world and they say, this is our conclusion. And then you come along and you say, because of the World Bank research and other such data, you have a bullish bias. And that means you buy dips. You buy dips every day if you get them for the next 5 years. Along the way, you reassess, unless something else changes. Okay? But this is what my whole book is about. Strategic and tactical Forex trading. You develop a fundamental bias any way you can, right? And then you look for times to execute the trade. Therefore, you don't have to wonder about, is oil going to go up or down? You're just interested, is this a dip and can I buy it? Is this a dip and can I buy it? So now if you look at this as your bias, okay, this is still based on what? Market. Okay, and this is based on price. So now you have to wait for market conditions to be appropriate, and that's where seasonality comes back in. So in times when demand is rising, okay, to June 1st, oil prices are more likely to rise. And then from this period, more likely to be sideways. And then this period, more time to be down. And then you should have that incorporated in your process of buying. And this, all this knowledge put together would make you a professional energy complex trader. See how easy it is? It may not be easy, but boy, is it interesting, huh? So, do you follow the API's, American Petroleum Institute's Economic Industry Outlook? Well, according to the chief economist, Dr. Dean Foreman at the American Petroleum Institute, he says blah, 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 and I incorporate some of this data in my fundamental bias. Oh my. Oh. Meta says, yeah, but if you get your bias wrong, they'll be sitting on your hands more of the time, which is better than losing money, correct? Total U.S. petroleum demand, 19 million barrels per day, decreased. Why? COVID-19. Refining and petrochemical demand for other oils remains solid. Refining throughput, 14.5 million barrels a day, recovered and actually increased. Well, that means oil prices would go up, right? Cool. The question is, when will we top out? Does anyone know why I have my peak oil theory at June 1? Does anyone know where I got that number? Was it the PhD from the API Was it the PhD from EIA? Was it a PhD from OPEC? Was it a... No, I used to employ Kurt Worley, who has a master's degree in applied statistics. And I asked him to go through 25 years of oil inventory data. And that analysis said June 1. Okay. Okay. This when seasonal start? No, well, seasons always start. Like when does the year start and end? The time never stops. So you're asking me, like, tell me about the season. Look what I'm actually showing you right this second. Look what I'm actually showing you. Hello? We're at the extreme low end of the range, looking at a 5-year average of the range. Broken out over the course of a year. So you're looking at 5 years of data. Anyways, so, right? So, look, we're back above, and we're back closer to the 5-year top range. Okay? Anyways. So you need to look at all this stuff. And by the way, I fully plan on having a cigar in about 10 minutes. Whenever we're done. And I like to sit and I think about these things. Are you telling me that the American Petroleum Institute actually releases data on projected petroleum exports? Wait, Wayne told me that exports increase dollar and imports decrease dollar. Wait, where are we now? Well, our exports have dropped precipitously below last year and well inside the 5-year range, which would indicate dollar weakness. Holy crap, the dollar's been weak. Yeah, you're welcome. And if imports go up, that means we're exporting dollar. Oh my God. Okay. Look at all this fabulous information. Okay. I'm sorry I geek out on this stuff. Okay. But my kids are going to college in a couple of years. And I need hundreds and hundreds of thousands of dollars to send these beautiful young adults to college. And so I look at this and I'm like, well, this information's got to get them through at least one semester. Okay? So maybe you should also geek out on API's Distillate Economic Indicator and ask yourself, how can this help me make an economic indicator and an economic investment decision? Okay. Is it going to look like this? Are we going to go from -1 to 0 to 0 to +1? And if so, how do you make money? How many people have never gone to this website before? Not EIA. Sorry, that's EIA. EIA or API. I guess the bigger question is how many people are going to spend time on it now? Okay. I took an entire class on the oil industry because I thought it might make me a better investor. Peter says, beware, Wayne, on Kinder Morgan because it was involved in the XL pipeline, moving oil from Canada to America and all that kind of stuff. Okay, so there's expected future cash flows and then there's current discounted cash flows, right? So I think if you look at a Kinder Morgan type stock, that's going to be in the price, right? So if it was expected, but anyways, let's go back to this. I don't think it's really a stock that moves all that much, and it's much more of that of a defensive cyclical type stock. It's not a growth stock. It's not going to go from $6 to $36. It kind of just farts around, and what they're doing is they're using the equity market similar to a bond market where they're like, look, buy our stock and we're going to pay you a hefty dividend. 7% a year. So, Peter, I believe the investors into that kind of stock let's say 5 years. 1 year. So over the course of a year, it went from 18 and now it's 17, right? And the low was 12. So you're like, well, that's a pretty big move, right? It's now paying 6.3% yield. Remember, down here would have paid almost 10%, depending on the price. Because remember, it's the interest rate over your price gives you your yield. So the low was 11.5, the high was 18. We're at 17 now. But if you look at the stock market, some stocks have doubled in this period, and this has moved half of that. And other stocks have more than doubled. So this is what they call a low beta. Okay. And maybe this move here from July to here or whatever. I don't know if this impacts with Keystone being canceled and stuff, but people are investing into this in the old school way. Look at this, right? People that buy this is not a growth stock. It's not going to triple in value in the next 5 years. But what they're doing is the expected return of the stock, right, is equal to the risk-free rate of return plus its beta to the market, and the market is the expected return, right? The the expected return of the market now, right, minus the risk-free rate of return to get the market above what the opportunity cost, right? So the expected return of the stock of this stock is equal to the risk-free rate of return plus its beta. So you might get like 1.5% plus a beta of, let's say, I'm going to guess 0.75 beta. And then you have to define the market because this is how much the stock moves against the market, which is a fancy way of saying, if the S&P 500 is up or down 1% today, it's only going to be up or down 0.75% a day. So it moves less. It has less volatility. So you look at all this, and this might seem like a lot of volatility, but if you look at it compared to what the entire S&P 500 did, or individual particular other stocks, like how much did Google and Apple move this year and Tesla move this year relative to the S&P 500 versus this company. So this one moves less than the S&P 500. Tesla probably moves significantly more than the S&P 500. So you'd have to look at this and say, wait, they're not actually investing into this like buying Tesla stock. Instead, they're buying it like a bond. Okay? So against current price, it's paying 6%. Dude, the 10-year T-note is paying 1.56 right now. And this is paying 500% more than the 10-year T-note. And if you had bought it at the beginning of the year, you'd be earning, like I said, I almost bought it sort of in this period. And at that point, I would have earned more like 7%, which if you compounded, you take your dividends and you buy more of these shares, eventually 10 years later, you get 100% of your money back. So if you were going to own the stock for 20 years, so like I have 20 years to retirement, my money would be up 200%. Plus any appreciation this stock actually gets. But this would be like income. Okay? So I might have 200%, not 100%, 200% more shares. Plus, if I had bought at this price, let's say at 15, and in 20 years it's at 25, I would have 200% more of the shares, and it would be up $10 per share more. And now I can be that old guy I could be that super old guy driving around in my yellow Lamborghini, and I'll say it's my Kinder Morgan. And meanwhile, Tesla stock will have gone from $200 to $2,000 to $100. And I'll just simply climb this way because I'm buying it like a bond. Okay. Okay. So the thing I have, the worry, Tesla, right? What is it priced at now? Is it 40 times earnings? Which means to get the price of Tesla stock, you have to take all its earnings and extrapolate it out 40 years in advance. What's Tesla going to do in 5 years? When Toyota, Honda, Ford, right? Kia, Hyundai, which is the same company but different brand. What? GM, Porsche, Mercedes, Volkswagen, right? Audi, etc., etc., etc. They all have kick-ass electric cars. I don't know about Volvo, Peter. Okay. In 5 years, every single one of these companies will have very well made, fantastic, full electric vehicles with long ranges, beautifully built, and Toyota will have it in 180 countries globally. Honda will have it in 180 countries, right? Ford will have it in 150 countries. Kia and Honda will have it in 100 countries. Do you think Tesla will still be worth 40 years, 40 times earnings? What always happens in history? The disruptor gets disrupted. Peter's like, no way. Yeah, well, so I don't know. Like, so I worry about these things. So, right? Okay. Yeah, guys. So this is why, like, it pays a lot to be 5% smarter than everybody else. And I think you have the capability. When you're like, wow, is it really worth 38 times earnings? Probably not. Anyways, cool. So just, I love this thought process, guys, because what we're talking about now is the difference between fundamentals and the market. And the market is reflecting seasonality. So there's this, like, you have to understand the price that you want. Okay. And the price is going to be reflected in where we are in the year, because that's the supply and demand. But then we're looking years in advance, right? So I guess we could go like the price, the month, and then the year. There's multiple things going on. And sort of timing where you are, or at least knowing what you want to do, is going to be very, very helpful. Peter says, so how are things priced in? Okay, in a normal market, let's say not manipulated by the central bank or the central bank or the central government. Normal. In a normal market, when we move out of a period like this, so let's say this was the Fed. Let's say we're not looking at a daily chart, but maybe this represents 2 years. Maybe it already does. Maybe it is almost 2 years, right? So anyway, so the Fed's coming in, right, and the government stimulus and all that kind of stuff. And let's say the Fed is now no longer pushing this up. No more stimulus. Let's just say now we're in a normal market. And now a professional is the one that makes money, says, I have a long-term bias and I understand seasonality, which is another way of saying the market. And there's going to be discrepancies in price and market. And you need to be smart enough to know when to invest and when not to invest. Or if you're a stock trader, just buying the S&P 500 in here was enough. Just buy the market. Just buy the market. Just get the market. Buy the S&P 500. Well, now you're in here. What if the S&P 500 generally moves sideways? Like, this is up 30%, but now you only expect it to be up 8%. So how do you outperform? Well, now you have to be the professional investor that says, buy stock A, buy stock B, buy stock C, and you're the one and you're smart enough to say, well, this is a growth stock, and then take profit, and then buy the cyclical stock, and then take profit, and then get back into the growth stock, but at a lower price, and let that run until we get a breakout. And now you're doing more than just buying the market, just buying the beta. You're actually picking stocks, and you're using seasonality to know what kind of stocks, what sectors of stock, if you're a stock trader, right? You understand? Like, now you're doing way more than most, and you're just smarter, making better decisions. But you might be making 5% better decisions, but producing 50% more value. Okay? And that's really how you price in your investments. Okay? So, like, this is good, but where is future demand going to come from in the second half of the year. Okay. Now you will have to say, well, I'm bullish, right? You're bullish for, 12 months. But the next 6 months, right, could, the next 6 months could underperform the 6 months after. Or, right, or whatever, however you want to write it. The first 6 months of the next 12 months will be less, whatever, right? So when I see something like this, I made a big stink, didn't I? I'm like, that could be interesting. And if not this one, certainly the next one could be interesting technically. Okay? So now you would have to say, as a bull, you could buy in here at 60. But you're not going to be as confident as you used to be. But you're going to buy it anyways. And then manage it accordingly. And you're like, well, what if I take a loss? Nobody is paying you to be perfect. You're getting paid to analyze opportunities and manage the risk. Nobody wants a perfect trading history. It's foolish to even try. What you need to do is make money and manage risk. So you could say, well, I think oil is going to be bullish for the next 5 months, let's say. Whatever. Well, then get in the trade. Well, but this doesn't look that good. Then manage the risk. Okay. Hope says she's all for Tesla. Cool. I'm just pointing out a thought process. I'm not saying that's the right decision, right? But right now, Tesla is priced on essentially having no competition. In 5 years, in my opinion, every single major global car company will have very, very good electric cars at all price points, and they already have a full distribution supply chain. So like when Hyundai rolls out Hyundai cars and Kia cars in Norway, Norwegians are going to buy them. And that's less Teslas sold, right? Cool, right? So again, I'm not telling you that, one thing or another. I'm asking you to think a little bit more than most people. That's all. And then you come up with your own decision. So Kia. So I'm not sure if Kia likes them or not. Kia. What is it called? A Telluride. Yeah. Okay. For example, this basically looks like a Neo, but so one of the things I like to do, because I've been thinking about the car industry, I've been thinking about Kia, which is owned by Hyundai, and Hyundai is not, it's an OTC stock in the United States. It's not on a real exchange like the New York Stock Exchange or something, but it's really a stock that trades in Korea. And I'm like, because of that inefficiency, I can probably get a better price. I'm not so sure. But now I have to look 5 or 10 years in advance. And Kia has a factory here in Georgia / Alabama border. It's a huge facility. So I see a lot of Kias around here because it's a local car, literally made in America, about, an hour and a half from me. And so they sell quite good. I see them. I'm familiar with them. And so one of the things I was doing in my research is I was looking at the recent Consumer Reports website. Right? And they gave this like a 95 score. So then I looked further, and it's a big SUV. It looks nice enough. Looks like a BMW, doesn't it? I'm telling you, this looks just like my BMW. I mean, I'm telling you, that's my BMW dash. That's my BMW thing. Look, it's got the Porsche. It's got my Porsche handles. I never noticed that. It's got my BMW widescreen. Like, dude, this is a BMW with Porsche Cayenne handles. Okay, now I want to show the back seat, and I haven't looked at this yet. Oh my God, that looks like a BMW. Okay, this is the back seat. It's got captain's seats. Okay, the BMW X1 with white leather, captain's chairs in the back seat. I drove it. I priced it out. I think it was something like $120,000 BMW that looks just like this. And this is a lot less than $120,000. Okay? But it's a giant ripoff of a BMW X7. Cool. This is a pretty good car. And what I'm also trying to get to is Consumer Reports rates it as the best built SUV in America. It's got a higher quality rating than the $120,000 BMW X7. Okay. Obviously, in 5 years, this will be just like NIO. Now, NIO is interesting because it's the Chinese Tesla, and they started with all SUVs, right? So anyways, what I'm saying is in 5 years, vehicles like this made by Kia are going to be full electric. And they'll roll this out, and they will definitely be able to compete with Tesla. Now, maybe it's not as flashy and stuff, but you know what? Mercedes will make the flashy one. This is competing against BMW. They're basically telling you, hey, would you like a BMW X7 for half price? You're like, well, I wasn't really thinking of a Kia, but damn, you start driving it, and you're like, damn, this is nice. And how much is it again? 100 and what? And they're like, dude, it's not even close to 100,000. You're joking, right? So now they're going to compete with BMW. Mercedes is going to compete with Tesla, and all of a sudden, if you translate this out, right? If you look at this like companies like this, now imagine Toyota and Honda, for example, Kia, Hyundai, Porsche, Mercedes, BMW, they all have in their segments, at their price points, beautiful electric cars. Okay. Now Lee says, well, maybe that's when Tesla turns back either into a platform company or into a battery company. Okay. Yeah. Well, then there's going to have to be something, right? But my point is, in your analysis, you have to at least assume such information and say, again, I'm just picking on Tesla. I don't know anything about Tesla, but if Tesla's stock price is at 38 times earnings, and you look at this and say, dude, Kia they've invested a lot of money into their electric, but so is Honda and Toyota and all that kind of stuff. When Kia rolls this out in Norway, when NIO rolls out in Norway, there's going to be some very big competition for the Tesla SUV with the gull-wing doors, the X or whatever it's called. Now you're going to have some very good competitive choices. And I don't think they'll sell as many Teslas. Some Norwegians will buy this Kia Telluride because it's a freaking good vehicle, probably for half the price. It's going to capture market share. It's going to. If you've studied marketing at all, which is a fabulous social science, by the way, I love it. But if you study it all, they will capture segment. Okay? So, cool. So then you have to look at it and say, well, what's Tesla worth? Okay? They might double their sales in the next 5 years, but they might lose 20% market share because more and more the market will get bigger and they'll continue to sell. So I'm not saying it'll go away, but what's it worth? And when you start thinking like that with stocks, like what's it worth? Are you buying a stock for 5 or 10 years in advance, or are you just flipping it to make a quick buck? So what are the fundamentals of the globe? What are the fundamentals of the market? And does seasonality apply? Does anybody know the seasonality of buying cars? Car sales seasonality. Let's see if we can find something. Right here. Okay, this is Investopedia. The two peak season for auto sales occurred during the spring, from March to end of May. Then it stops September to November. Okay. By the way, this is not just for cars, but it's a pretty, obvious thing to think about. Okay, so when do you buy? Do you buy the stock after they report huge sales or before they report? Okay. Yeah, Chuck Dux's Kia scores are very high. The highest, 95% is awesome. I kind of laugh though, because there's a segment that they study and they say, 2-row SUVs priced over 85,000. Right? It's funny. My Porsche gets the highest score. And I'm like, I told my wife, I'm like, oh, I made such a good investment decision. It was so awesome. Out of all the SUVs priced over between 185, I think it was like to 200,000. It was pretty funny. For all 2-row SUVs priced between 85,000 and 200,000, my Porsche got the highest score, which is really funny because I don't think there is another SUV in that category. Like, what other category are they? Who else is in there? I don't think they throw in the X5, but they do say the BMW X5 is one of the best vehicles they've ever driven, because they've made millions and millions and millions and millions and millions and millions and millions. They haven't changed anything except the interior on that vehicle for 20 years. They're really good at making them. But I think it's priced in a different category than the Porsche. So anyways, it's funny. Statistics. Right? All right, cool. All right, so anyways, going back to, let's do some gold here. We hit off the top, you see? There it is. There's our double bottom. There's our high. There's our 382. Okay? Remember, a 382 predicts a 1382, which is here. But pivot points, say M2 to here. And then, of course, we know we call this what? An Arctic turtle. Turtle. Anyways. Chuck Texas Porsche 911 has the highest for a model. Yeah, and that's because, again, they've made millions and millions and millions and millions and millions of these 911s, right? They're very, very good at it. So you can imagine they're like 1 year, there's a small squeak somewhere. So they spend the whole year re-engineering the thing so it doesn't squeak. And then on another year, the next year, oh, there's a squeak somewhere else. Well, after 30, 40, 50 years, right, there's no squeaks. Okay. Now, Lee says Kia's recalling 147,000 cars. Okay, so now we're looking at, global macro. Then we're talking about industry and then seasonality in industry as well as fundamentals of industry. And then you have to break down into subcomponents of that until you get to a particular company and you're like, okay, I'm really interested in maybe Kia, but maybe Kia's overpriced because of this recall. But more what I'm interested in, Lee, is if I think Kia over the next 10 years is going to be a company that performs well and maybe, right, we'll just say performs well, and then they get slammed by, a recall, and that lowers the stock price, then to me there's going to be a disconnect between long-term intrinsic value and short-term price fluctuations. So like I might buy Credit Suisse. Why would I buy Credit Suisse? They're getting clobbered. Yes, I want them to get clobbered. Because the first thing is, will Credit Suisse be a bank in 20 years? I have to answer that question. I don't know. And if so, will being slammed again by the hedge fund that made them lose billions, right? And they have had to raise some capital that's coming out soon. They're raising capital, all that kind of stuff. But what's the output of this bank? Bad apples have been fired, or at least warned, right? Risk management will be adjusted. The bank's going to be recapitalized. There's going to be sort of a new business scrutiny internally and externally, so that the bank might actually be better than it was a year ago. So if stock 10 years ago was $20, 1 year ago was $15, but now I can buy it for $10. And if I have the capacity to sit on it for 20 years, maybe over the next year or two, it kind of farts around 10, 11, 12, 10, 11, 12. But 20 years from now, it's a $40 stock. Then, right? Keep in mind, if I was able to buy this at a time when other stocks are up 200%, what am I going to do? Buy a stock that's up 200% for the year? Or can I buy something that's down 30% because of some bad news and a shocking scandal? But ultimately, a better company will come from it. So then maybe I buy it. My question to then would be, do I buy it at 10 or do I wait for it to 5? Now, Johnny says, or Deutsche Bank. Now, Deutsche Bank has a lot of internal problems too and has been crushed. But maybe they'll also come out of it better. Right? So I know somebody that had so much money locked up at Deutsche Bank, they couldn't actually withdraw it. The bank wouldn't give them money. And I know he spent years suing them. And finally, Deutsche Bank gave him his money. And by coincidence, right, literally the same week, Deutsche Bank raised more money by issuing more stock. And it was about the same amount of money they raised as they paid him. So I know that means at that particular time in history, Deutsche Bank was really insolvent. So have we seen the exact bottom of Deutsche Bank? Then probably, right? So now do you start buying back in? Sure. Okay, maybe. Another Johnny's thought also is like, when something hits a market and then everything is punished, then you need to buy the one that's unfairly punished. Okay? Because think of it, let's say there's a scandal in an industry. Think of the companies in the industry as boats. And then you also have the normal ebb and flow of, a tide. So now you got this tide. Okay? All right. So a scandal hits and 2 out of the 10 boats have holes in them. Like literally holes in the hull, water's filling into the boat, but the tide is also falling for everybody. So the price of all 10 boats are going down. But only 2 of the boats have holes in them. So when the tide raises back up, the 2 boats with holes in them stay at the bottom and the other ones rise back up. So you want to look for a situation where 2 boats lower all 10, and what you want to do is buy everything else that has a true mispricing, and you buy that. Now, currencies are very much the same thing, where we're looking at there's fundamentals, there's seasonality, there's irrational exuberance, all this kind of stuff. And then inside of that, you have like news releases, oh my God, did you see weekly jobless claims? Boom. Well, very often these news events can create a mispricing over the course of a couple of hours, over the course of a few days, in the course of, and then as you back out into bigger, you're getting closer and closer to true macro trend forces. And what you're trying to do is line up the market by using technical analysis to analyze price. And this is what I've been doing for 20 years. It's the whole purpose of my book. What is the fundamental trend? And now, how can we use technical analysis to find the right price and time to buy or sell? That's it. That's the secret sauce. Okay? Strategic and tactical Forex trading. The strategy is your understanding of bias. Are you a bull or a bear? Are you long-term long or short-term short? That's all strategy. And then once you've decided on your strategy, what is the exact time and price to buy or sell? That's technical analysis. That's tactics. Okay? Why are you attacking people in Afghanistan? But also, how do you kick down doors and put ammo into targets? There's 2 different things. The how, the why, and then the how. Okay? And I think even if you're very, very good at what you do, if you don't understand the why properly, but even if you're very, very good tactically, it ends up being in a stalemate. Break even. Modestly profitable, modestly losing, but nothing major is happening because your tactics are so good, but it's a never-ending war. And at the end of it, it was all for nothing. That's what tactics only gets you. But if you understand the why, and then you have the how, you're going to have a much more satisfying outcome. Peace on earth. May the pips be with you. May our profits be above average. I'll see you tomorrow. Cheers.